Did you know that a simple investment in the S&P 500 has beaten over 90% of professional fund managers over the last 30 years? Let that sink in. That means people with Ivy League degrees, massive research teams, and access to insider-level data still lost something you can buy with just a few clicks on your phone. Today, we're breaking down what the S&P 500 actually is, and more importantly, why it always seems to win in the long run. We'll also talk about Warren Buffett's famous bet and why one of the greatest investors of all time believes most people should stop trying to be smart and just own the S&P 500. Whether you're brand new to investing or you've been in the market for a while, this video can completely change how you think about building wealth. Just a quick favor before we dive in, hit the like button, subscribe to the channel, and turn on notifications. On this channel, I break down business, technology, and money in a way that actually makes sense. You'll learn how to invest, understand market trends, and make smarter long-term financial decisions so we can build lasting wealth over time. Let's get into it. What is the S&P 500? At its core, the S&P 500 is a stock market index. That means it's not a company, it's a list. Specifically, it tracks 500 of the largest publicly traded companies in the United States. We're talking about names that we already know about: Apple, Microsoft, Amazon, Google, Nvidia, and Meta. Together, these companies represent 80% of the total value of the US stock market. So when people say the market was up today, most of the time they're really talking about the S&P 500. The S&P 500 is market cap weighted, which just means bigger companies means bigger influence in the S&P 500. For example, if Apple makes up 7% of the index and they have a big day, the S&P 500 will feel it. If a smaller company struggles, it barely moves the needle. This is important because the index naturally leans into winners and leans away from losers over time. A little history about the S&P 500. It was officially introduced in 1957 by Standard & Poor's. Since then, it's become the gold standard benchmark for the US economy, the stock market, and long-term investing performance. If someone says they beat the market, this is what they're usually comparing themselves to. How do you actually invest in the S&P 500? You can't buy it directly, but instead you can invest through index funds or ETFs that track it. Popular examples are VOO, SPY, or through Fidelity, which is FXAIX. When you buy one of these, you instantly own a tiny piece of all 500 companies. There's no stock picking, there's no guessing, and there's no stress. One of the most powerful things about the S&P 500 is that it's self-cleaning. Companies don't stay there forever. If a company shrinks or if it falls behind or stops meeting the criteria, it gets removed. If a new company grows big and important enough, it gets added. That means the index is evolving with the economy. Railroads turned into oil, oil turned into tech, and tech turned into AI. You don't have to predict the future. The index adjusts it for you. The S&P 500 is passive by design. No one sits around trying to guess which stock will win next year. It simply mirrors the market. And ironically, that's exactly why it works so well. Why does the S&P 500 always win? Let's talk results. Over a long period of time, the S&P 500 has returned about 10% per year on average. That includes crashes, recessions, wars, pandemics, and tech bubbles. Now here's the part that most people don't realize. Active funds versus the S&P 500. Over a 30-year period, roughly 90% of active fund managers fail to beat the S&P 500. Why? Fees kill returns. Let's cover an example. Let's say you invest $100,000 and earn the same 8% gross return before fees. With an active fund charging 1.5%, your real return drops to 6.5%. In the S&P 500 index charging 0.03%, your real return is basically 7.97%. Now fast forward after 30 years with the active fund, your $100,000 grows to about $660,000. And with the S&P 500 index, the same $100,000 grows to about $1 million. Same market, same performance. The only difference is the fees. That 1 to 2% doesn't look scary in a single year, but over decades, it quietly turns into hundreds of thousands of dollars that steals dollars from your future. That's why Warren Buffett says fees are one of the biggest enemies to long-term investors. Stock picking is extremely hard. Markets are competitive. Millions of investors are pricing in information instantly. Beating the collective intelligence of the market consistently is almost impossible. Diversification. When you own the S&P 500, some companies will fail, some explode higher. You don't need to know which is which. The winners carry the index forward. Active managers can win in short bursts, especially in down markets, but over decades, the boring passive approach keeps winning. Next, let's talk about what Warren Buffett says about the S&P 500. This is where things get serious. Warren Buffett is one of the greatest investors of all time. He is a massive believer in the S&P 500. He gives advice, which he calls the 90-10 rule. Buffett has said that for an average investor, put 90% of your money into a low-cost S&P 500 index fund and 10% into short-term government bonds. That's it. There's no complex strategies, there's no stock picking, and there's no concentrating. Let's look at the famous $1 million bet that Buffett made. In 2008, he wagered $1 million that a simple investment in the S&P 500 index fund would outperform a group of professional hedge funds over 10 years. What was the result? The S&P returned 126%, while hedge funds returned on average 36%. The professionals lost, and they lost badly. Buffett won, and he donated the winnings to charity. One of his most famous quotes is a low-cost index fund is the most sensible equity investment for the great majority of investors. And this part matters. Buffett even instructed that his own family's inheritance be invested that way. If it's good enough for Warren Buffett's money, it should be good enough for the most of us. Let's look at the pros and cons of investing in the S&P 500. A couple of the pros: you get instant diversification, extremely low fees, strong long-term returns, simple and stress-free, and it's beginner-friendly. A few of the cons: it has short-term volatility, market crashes will happen, and it's not exciting or flashy. But here's the key lesson: time in the market beats timing the market. Most people fail because they panic sell, they chase hype, and they overcomplicate investing. One of the best ways to invest in S&P 500 is dollar cost averaging. You invest a fixed amount every month, no matter what the market is doing. Apps and platforms like Vanguard, Fidelity, Schwab make this incredibly easy. In the end, the S&P 500 isn't just an index, it's a wealth-building machine that rewards patience, discipline, and long-term thinking. It survived every major crisis in modern history and kept moving higher. And one of the greatest investors of all time says, this is what most people should own. It's probably worth paying attention to. If this video brought you value, please go ahead and comment, like, subscribe, and share with someone who's trying to get smarter about money. I'll see you in the next one.